In January 2000, AOL and Time Warner announced a merger worth roughly $165 billion, at the time the largest corporate merger ever attempted. The deal closed the following year. Within about 2 years of closing, the combined company recorded a write-down of close to $99 billion, one of the single largest write-downs any company has ever recorded in corporate history. The deal was framed, at the time, as a genuinely visionary combination. AOL brought internet reach, tens of millions of dial-up subscribers, and a direct pipeline to consumers coming online for the first time. Time Warner brought a sprawling media empire, cable networks, magazines, film and television production, decades of established content and distribution. Put together, the pitch went, you'd get an unstoppable combined force spanning the entire future of media and the internet at once. What actually happened, almost immediately after the deal closed, was a collision, not a combination. AOL's culture moved fast, thought in internet time, and operated with the scrappy urgency of a company that had grown explosively in just a few years. Time Warner's culture had been built over decades around traditional media production cycles, established relationships, and a much slower, more deliberate operating rhythm. These two cultures never meaningfully merged into one functioning organization. Executives on both sides described years of internal friction, competing priorities, and turf battles that had almost nothing to do with serving customers, and almost everything to do with two very different corporate cultures being forced to share one org chart. Meanwhile, the deeper problem sat underneath the culture clash entirely. The whole transaction rested on one core assumption: that AOL's dial-up internet subscription business would keep growing at a healthy pace for years to come. That assumption collapsed almost immediately. Broadband internet access expanded rapidly in the years right after the merger closed, and AOL's core dial-up product, the actual engine behind the deal's enormous valuation, became functionally obsolete within just a few years of the ink drying on the largest merger in corporate history. Leadership on both sides of the deal had spent enormous time, energy, and legal effort negotiating the actual terms, the exchange ratios, the governance structure, who would run what, who would report to whom. Almost none of that same effort went into imagining, in concrete daily detail, what operations would actually look like once two structurally different organizations had to function as one company, serving real customers, on a real Tuesday morning, 6 months after the announcement had stopped making headlines. This pattern generalizes far beyond one enormous, famous merger between an internet company and a media conglomerate. Anytime two teams, two departments, or two companies are formally combined on paper, the deal itself, the term sheet, the valuation, the legal structure, is almost always the easier part. Real difficulty lives entirely in what happens after the signing, in the operational and cultural integration that follows, and that integration work reliably gets far less serious planning attention than the negotiation that preceded it, precisely because negotiation has a clear finish line, a signature, while integration doesn't. Gerald Levin, the Time Warner CEO who championed the deal from the media side, gave interviews years later expressing genuine public regret over the merger, at one point calling it one of the biggest mistakes of his career, and offering something close to an apology to shareholders who had lost enormous value. Steve Case, AOL's co-founder and the deal's other primary champion, similarly acknowledged in later years that the vision behind the merger had been fundamentally undermined by how the two companies were actually integrated, or rather, how they weren't. Both men had negotiated what looked, on paper and in the press coverage of January 2000, like an obviously visionary combination. Neither had built a realistic plan for the operational reality that followed. The stock market's verdict was swift and brutal. The combined company's share price fell by more than 80% within about 2 years of the deal closing, wiping out a staggering amount of shareholder value almost as quickly as the merger had been celebrated as historic. That collapse wasn't driven by one single bad quarter or one specific product failure. It reflected a steady accumulation of missed integration milestones, executive departures, internal power struggles between AOL and Time Warner factions, and the slow-motion collapse of the dial-up business model that the entire deal had been priced around. This wasn't an isolated failure mode unique to internet media combinations either. The 1998 merger between Daimler-Benz and Chrysler, at the time billed as a landmark transatlantic combination of a German engineering powerhouse and an American manufacturing giant, ran into a strikingly similar wall. A genuinely difficult cultural mismatch between German and American corporate norms around decision-making, speed, hierarchy, and communication style, one that persisted for years, and that the deal's own architects had significantly underestimated at signing. Business schools now teach the phrase cultural due diligence specifically because of cases like this one. The idea that evaluating whether two organizations can actually work together deserves the same rigor, the same dedicated team, and the same pre-signing investigation as evaluating whether the balance sheets and legal structures line up. Most deals still only do the second kind of due diligence, treating the first kind as something that will presumably sort itself out after signing. Here's the part worth sitting with directly. A merger's terms can be genuinely brilliant, favorable to both sides, well-structured on paper, reviewed by the best lawyers and bankers money can buy, and the whole thing can still fail entirely if nobody seriously plans how the combined group will actually work together day to day. Deal terms determine who owns what, on paper. They don't determine whether two different groups of people, with two different sets of habits, incentives, and unwritten norms, can actually function as one team without spending years fighting each other instead of the market. It's worth being specific about what cultural due diligence would have actually looked like in practice, rather than leaving it as an abstract phrase. It means sitting a sample of AOL and Time Warner middle managers in a room months before the deal closes and asking them to walk through, step by step, how a single piece of shared work, approving a joint marketing campaign, deciding a content licensing arrangement, allocating a shared budget, would actually move through both organizations' existing decision-making processes. AOL's internet-era culture favored fast, informal decisions made by small groups. Time Warner's media culture favored slower, more consensus-driven decisions that ran through established editorial and legal review chains built over decades. Neither approach is inherently wrong. They were simply built for different environments. Running that single exercise honestly, before the deal closed rather than after, would have surfaced the friction the merger actually experienced, months or years before it played out expensively in real time with real executives, real budgets, and real shareholder value on the line. The broader financial lesson matters just as much as the cultural one. A merger valuation is only as sound as the assumptions baked into it, and the assumption doing the most work in the AOL Time Warner deal, that AOL's existing subscriber base and revenue model would keep growing at a healthy clip, was never seriously stress-tested against the very real possibility that broadband would arrive faster than the deal's financial models assumed. That's a distinct, more analytical failure, sitting right alongside the cultural one. Nobody with real authority in the room was incentivized to build the pessimistic case and defend it forcefully, because doing so would have undermined the enthusiasm driving the largest merger in corporate history at the exact moment it was being celebrated in the press. There's a specific organizational dynamic worth naming here, because it explains why nobody built that pessimistic case, even though plenty of people inside both companies could plausibly see it coming. Once a deal of this size and visibility is publicly announced, with press releases issued, congratulatory statements from both CEOs on record, and Wall Street analysts already reacting, raising a serious internal objection stops looking like careful due diligence and starts looking like an attack on a decision that has effectively already been made in public. The window for genuine, forceful, internal dissent closes the moment a deal like this becomes a public announcement rather than a private discussion. Because at that point, questioning the deal's core assumptions means questioning your own CEO's judgment on something the entire business press is already praising. That timing problem is worth remembering for any leader running a significant internal decision, not just a merger of this scale. The moment you announce a decision publicly and celebrate it internally is very often the exact moment you lose your own team's ability to tell you honestly that something about it looks wrong. What makes the AOL Time Warner case endure as a teaching example decades later isn't really the size of the number, striking as $165 billion and a $99 billion write-down both are. It's that two genuinely capable leadership teams, running real, previously successful companies, spent enormous effort getting the financial architecture of a deal right, while treating the actual human and operational integration as an afterthought. Exactly the imbalance that keeps showing up in merger after merger across entirely different industries decades apart. There's a small, practical habit worth adopting from this case, regardless of the size of the combination you're actually running. Before any two teams, departments, or companies are formally merged, write down, specifically and in detail, the three biggest points of friction you expect once the paperwork is signed, not the three biggest opportunities the combination is supposed to unlock. Nearly every merger announcement is saturated with the opportunity case, because that's what gets a deal approved and celebrated. Almost none of them are forced to write down the friction case with equal rigor and equal seniority behind it, and that asymmetry, not any single bad number in the deal terms, is what quietly determined how the AOL Time Warner merger actually played out once the champagne from the announcement had gone flat. That same asymmetry shows up at a much smaller scale constantly, inside ordinary internal reorganizations that never make a headline anywhere. Combining two departments after a restructuring, merging two customer-facing teams into one after a leadership change, folding a smaller acquired company's staff directly into an existing team's reporting structure, all carry the same basic risk profile as AOL Time Warner, just at a scale that never attracts an outside journalist's attention or a business school case study. The org chart gets redrawn in an afternoon. The actual, functioning working relationships, the informal trust, the shared assumptions about how decisions get made, take considerably longer to rebuild, and nobody schedules a dedicated planning session for that part, because it doesn't show up as a line item on any budget or slide deck the way the legal and financial terms of a combination always do. A $100 billion write-down is a dramatic, headline-grabbing way to learn this lesson. A team that quietly underperforms for a year after a much smaller merger, without anyone ever formally diagnosing why, is a far more common, far quieter version of the exact same mistake playing out at a scale small enough that nobody ever bothers writing the case study. None of this means the merger was doomed from the very first handshake. And it's worth resisting that overly tidy retelling too. The deal terms of AOL Time Warner were, by most accounts at the time, competently negotiated by experienced professionals on both sides. That's exactly what makes the outcome worth remembering. A well-negotiated deal and a well-integrated combination are two entirely separate accomplishments. And mastering the first one gives no guarantee whatsoever that the second one has been taken seriously at all. Every leadership team announcing a combination genuinely believes their own situation is the exception, that the culture clash and the operational friction other mergers famously ran into simply won't apply to them this time. And that belief, stated with total sincerity in boardroom after boardroom for decades since, is exactly what the AOL Time Warner numbers were still standing there, patiently, waiting to quietly disprove, long after the deal itself had faded from the front-page headlines and settled into a permanent, cautionary line in a business school syllabus instead. Still true, no matter how confidently the next generation of executives goes on to repeat the exact same reassurance to their own board, in their own boardroom, decades later. AOL Time Warner eventually reversed course. AOL was spun back off as an independent company in 2009, formally undoing the combination that had once been billed as an unstoppable force in media and technology. The remaining Time Warner businesses continued on their own separate path for years afterward. The $165 billion deal that was supposed to define the future of both internet and media instead became one of the most widely cited cautionary tales in business school curricula about exactly how badly a merger can go. Not because the math was wrong, but because the operational reality after signing was never seriously wargamed in advance. The internal power struggles weren't abstract either. AOL executive Bob Pittman, who became the combined company's COO, was pushed to deliver aggressive revenue targets to justify the deal's valuation to Wall Street. Targets built on assumptions about AOL's continued subscriber growth that were already becoming shakier by the time the deal closed. When those targets started slipping, the response inside the company was reportedly a wave of internal blame shifting between AOL and Time Warner executives, each side pointing at the other's division as the source of the shortfall, rather than a coordinated effort to fix the underlying problem. Several senior executives from both original companies departed within the first few years after the merger closed, taking institutional knowledge and working relationships with them right as the combined company needed stability the most. What makes this case genuinely useful, rather than just a famous cautionary headline, is how directly the lesson scales down to something far smaller than a $100 billion media merger. Any manager combining two smaller teams after an internal reorg, after acquiring a smaller competitor, after merging two departments that used to operate separately, is running a miniature version of exactly the same risk. The org chart on the slide deck can look perfectly clean. Whether the actual humans involved can function together day to day is a completely separate question, and it's the one that actually determines whether the combination works. Before signing off on any deal or reorganization of meaningful size, ask your own team to describe, in specific concrete detail, what a normal Tuesday will actually look like 6 months after the ink dries. Not the org chart, not the reporting lines, the actual daily texture of how two groups of people, with two different sets of habits and assumptions, are supposed to get real work done together. If nobody in the room can answer that question with any real specificity, that's the warning sign worth taking seriously. Long before the write-down ever shows up on a balance sheet, back when it would have still been cheap and quiet to fix, rather than public, expensive, and impossible to walk back. More management theories like this hit follow.